Good evening, Ilan. Over there, it's a bit later than here in Europe. Yes, thank you very much for doing this. So I'd like to briefly introduce Ilan. So Ilan is professor and chair in the economics of disasters and climate change at Victoria University of Wellington, New Zealand. He has consulted World Bank, Asian Development Bank, and International Monetary Fund, among others. We will today talk about on disaster insurance. So his talk will last approximately 40 minutes, and you are very much invited to make questions through the Q&A chat, even while Ilan is talking. And if the question is pertinent to the point, we can also make it right away. Otherwise, we address all questions in the last 10 minutes of, let's say, from 11:10 to 12. And then with this, I hand it over to Ilan.
Yes, so you can see my PowerPoint, yeah? Alessio, yes?
Yes, yes.
Excellent. Okay, so first of all, thank you, Alessio and Jana and Elena for organizing this and for giving me the honor of being the inaugural speaker in this webinar series. So thank you, and thank you very much for the audience. I already saw that there are some friends in the audience. That's even better. So what I wanted to talk about today, to fit with the theme of this working group, is to provide a dismal perspective, because of course economics, as Thomas Carlyle called it, is the dismal science, and a topic which, you know, a lot of people consider very boring, but I think what I aim to do here is to surprise you with a few findings from my previous research on this topic. So the intention here is, first of all, to stick to what I know from or what I found in my own research on disaster insurance, and to focus on stuff that is more surprising maybe than and maybe not entirely anticipated. I am going to try to cover 5 papers in 40 minutes. So forgive me for the ambition. So that means, of course, and because this is a sort of a multidisciplinary crowd, I didn't plan at all to dig into the details of exactly how we found what we found and what data we used and what, you know, techniques and so on. But I'm happy to answer questions if there are any questions. These are the 5 papers that I'm going to cover. All of them are available for download on my website. So if anyone is interested, the link is over there at the top. But you just Google Ilan Noy and you'll find the website and you'll find the papers. But before I start talking about what we found in those research projects, first of all, we need to think, why do we really need insurance? Why do we want insurance? Why socially? We think, of course, the insurance companies want profit, but why as a society would we want there to be disaster insurance? There's sort of 5 reasons why we could want insurance. The primary one, of course, is insurance is a mechanism to share risk. Insurance is also a mechanism to avoid destitution, because a lot of times what we are insuring is the asset that constitutes most of our wealth. For many people, for example, that would be the home. For firms, that would be the facility that they own. So by insuring those, we avoid typically people going into destitution and poverty. The third reason we might want insurance is because once a disaster hits, we think that insurance might speed up recovery or might even improve recovery. Okay, because there are all this, once there is destruction, insurance provides the funding that can enable a better and a faster recovery. The fourth reason is that we want insurance to incentivize risk reduction. So well-designed insurance contracts can, in principle, lead the agent, the person who is buying those insurance, to engage in risk reduction if the insurance contracts is structured in the right way. So for example, a lot of you have car insurance and you have a discount if you are a careful driver. So of course you drive carefully for many other reasons, but one more reason is because you know that your insurance is cheaper because of that. So you don't get, if you get a speeding ticket, your insurance rate might go up, for example. So that would be we would like insurance to incentivize risk reduction. The last reason is that with insurance, we think that there's more likely to be productive investment because the investors, if they know that their investment is protected by insurance, are more likely to invest. Okay, so if you want to invest in a new facility or a new house or a new bridge or whatever it is, if you can protect it with insurance, then you're more likely to do it. If on the other hand, you can't protect it with insurance because insurance, for example, is not available, you're less likely to engage in that investment. Now, I'm not going to talk at all about these two. And actually, remarkably, there is very little research on them. So we have very little evidence that insurance does indeed provide a lot of incentives for risk reduction that are actually changing behavior. Of course, we know examples of insurance contracts that do try to incentivize risk reduction, but whether that actually shifts behavior, there's very little research on that. And we also have very little evidence that insurance indeed increases productive investment. These are two areas, I think, where there's a lot of room for future research. And I'm not going to talk at all about them here. I'm going to briefly talk about the first three: risk sharing, avoiding destitution, and the speed up or improvement of recovery. So for risk sharing, we generally think about risk sharing across space. So that would typically be across customers, and then risk sharing across time. So I'm both sharing the risk of maybe my house when I buy house insurance with other people who are customers of the same insurance company. And I'm also sharing it with my future self because I buy insurance because I don't know when exactly the damage to my house will occur. I live in Wellington in New Zealand. We have a lot of earthquakes here. So, one obvious risk I'm insuring against is earthquakes. Okay. Now, ideally, what we would want is that or at least in principle, we think we may want more risk sharing across space and more risk sharing across time. The problem is that here the private sector and the public sector are pushing in very different directions. The public sector is generally interested in more risk sharing across individuals, so across the citizens of a country, while the private sector, as the competition between private insurance companies actually works to minimize the risk sharing across individuals, and insurance companies are constantly striving to improve their risk models so that they can do less and less risk sharing across individuals. So in principle, you can think of a future in which the private risk models are so good that insurance companies no longer do any risk sharing across individuals, because they can actually calculate exactly the risk for every individual and charge that risk to them. And of course, the competitive pressures will make sure that's going to be the case. So the private sector is always pushing us to the left. And in some cases, we see government intervening and not allowing the private sector to push us to the left. There's a lot of, as you can suspect, if the government is pushing one way and the private sector is pushing the other way, there are a lot of ethical issues around this idea of spatial risk sharing, so sharing across customers. And what is exactly the optimal risk sharing, I think, is not something we we have a settled view on. So, for example, we see that a lot with flooding risk, for example. In the UK, adopted a new, well, maybe 5, 6, 7 years ago, a new flood insurance scheme called Flood Re, in which they decided that the risk should be shared by everyone, including the people at the top of the hill. They should share exactly the same. They should share the risk with the people at the bottom of the hill, meaning in the flood zone. Is that a fair decision? So is that, ethically speaking, is that the right decision? I don't know. But then anyway, that's what the UK has decided on, and we observe that in a lot of countries where there seems to be a lot of risk sharing across individuals pushed on by governments, sometimes with sort of unrecognized aspects to it. And I think in most instances, this push towards more spatial risk sharing is very regressive. And here I'm giving you an example from New Zealand, where we have a public insurance scheme. And on its face, the public insurance scheme is very equitable. So this is for earthquake insurance. Everybody pays exactly the same to the public insurer. So every homeowner in New Zealand pays exactly the same amount in premium to the insurer, the public insurer, called the Earthquake Commission. And everybody gets exactly the same coverage, and that is the first $100,000 of damages to your house from an earthquake. So everybody pays the same, everybody gets the same cover, the first $100,000 of damages. Now, what you see here is actually, we had a big earthquake in 2011 in the city of Christchurch. We had about 300,000 claims from the public insurer for the damage to the earthquake. So this was a very damaging earthquake hitting the second biggest city in New Zealand. And we looked at those claims, those 300,000 claims, and identified what is the income of the household for which those claims were paid. And what you see is that there is a very clear pattern, so that poorer households got less money out of the earthquake, out of the insurance system than richer households. Okay, and this
Ilan?
we show. Yes.
There's a question.
Yes, please.
About is risk not always spatially shared? In the flooding example, even if the ones on top of the hill do not share the insurance risk, they share it ultimately through the common government that will have to pay when the insurance fails. So maybe you can explain a bit.
Well, the government doesn't have to pay if the insurance fails. The government can let the insurance fail, or the government can supervise the insurance so that it doesn't fail. So, you have macroprudential regulations that force insurance companies to hold enough so that they don't fail, in the same way that we have macroprudential regulation for banks. If the insurance fails, that's a failure of the regulator. So it's not inevitable that the insurance will fail. So it's not inevitable that the people at the top of the hill should share that risk. The government can also decide to let the insurance companies fail. The politics of that is difficult, but there are examples of that globally, and you could imagine that happening.
Yeah, I think we have a reaction from Chan. He said, of course, I guess he means that the public must intervene because people cannot just stay homeless or die.
So the public can intervene and provide some, shelter, but that's not full compensation for a loss. So I'm not arguing that, governments in most countries, governments will not just let you, die in the street. Even in very poor countries, governments, generally speaking, try not to do that. But there's a far cry between that and full compensation for the loss. So, you know, you can provide a minimum housing standard or through the welfare system, something, and you can decide not just to do that. And different countries do it differently. So it's not inevitable at all that the risk is shared by the people at the top of the hill. And how much is shared by the people at the top of the hill depends on the regulation. So for example, how strict is the macroprudential regulation? So here in New Zealand, for example, we have the insurers have to hold enough to for a damage from a 1 in 1,000 year earthquake. So in all likelihood, this is a very conservative regulatory policy because we had in the past an insurance failure because of an earthquake, but that probably means that, you know, we are not going to have insurance failure because of the biggest hazard in at least in this country, which is earthquakes. Okay, so but going back to this this issue of regressivity, so what we have in this example is an insurance that charges everyone the same, provides everyone exactly the same right, the claim to the first $100,000 on damages, and still comes out to be a regressive system. Now, why is it a regressive system? Basically, and we show that in the paper, we rule there are other possibilities why the payments ended up being regressive, meaning the rich got more. We show in the paper that basically the story behind this is that a wealthier household is more likely to have bigger damage for the same amount of hazard. So if the hazard, for example, the earthquake was such that the shaking was enough not to damage the building, but to damage, say, the television or the windows, the value of a television or a windows in a high-income home is much higher. So they get more compensation than the same television or windows that are broken in a poorer household, and that translates to almost twice as much compensation for the highest decile household versus the lowest decile. So it's a very significant difference in a system that in principle was designed to be very equitable. A lot of the public insurance systems in the world are way more regressive than the New Zealand one. Some of the European ones are incredibly regressive. The US National Flood Insurance Program is regressive. So there are many other examples like that. So we actually, what we show here is that one of the more equitable program is regressive itself. And that, so there is an argument why we shouldn't do that much spatial risk sharing, because those programs are typically very regressive. Now, when we think about risk sharing across time, that becomes more difficult when the risk is changing over time. And of course, the risk is changing over time because of climate change. And specifically, if we think of flooding, a lot of times it's associated with storm. The former president of the US, or the one who is still in the White House that doesn't recognize the fact that he is the former president of the US, he pointed out that storms are very wet. And he pointed out that they are very wet from the standpoint of water. Not sure what that means, but that's what he pointed out. But if we think about the distribution of, for example, rainfall or temperature, and this is just an example, this is an illustrative example, what we know is that the risk that is insured is this black triangle there at the bottom. So those maybe top 2.5% of damages or whatever it is. Temperature or rainfall or whatever else you can think about. But when this curve shifts because of climate change, the region, the frequency, of those extreme events increases by a lot. And because insurance typically doesn't insure high frequency events, much smaller events are going to, much more extreme events are only going to be insured with climate change. So the risk is shifting, and because of that, what insurance agrees and doesn't agree to insure shifts as well. If the distribution of that temperature or rainfall or whatever also becomes flatter, and in many cases we know that these things do become flatter, then this is even more pronounced, that shift for what is going to be continue to be insured. Now, what that generates typically a lot of tension, because a lot of times when the private insurers are saying, well, because of climate change, we don't want to cover that risk, then there is a strong political pressure on the public sector to provide that insurance. And we just saw that in California happen recently because of the fires. Private insurers said, well, we now recognize that the risk of fires is bigger than we thought, and therefore we don't want to keep insuring all those properties. As a stopgap measure, the regulator in California told the insurers, well, you can't drop insuring those properties. For now, as a temporary measure, you have to continue rolling over insurance policies. Remember that insurance policies are almost always 12 months policies. So there is very little long-term commitment. So this idea of maintaining insurance over time, spreading the risk over time, is problematic if insurance can step out at every point. We did some estimate of that in the New Zealand case, and here we're thinking about the risk being created because of sea level rise. Now, contrary to what people think, or some people think, sea level rise is going, while the sea level is rising slowly, the frequency of extreme events that are sort of flooding events, coastal flooding events that are associated with sea level rise is actually increasing much more rapidly than that. That's exactly the point, that the tail is changing because of the shift in the distribution. And we estimated that for the flood zone in the four biggest cities in New Zealand, Auckland, Wellington, Christchurch, and Dunedin, insurance retreat, so refusal of insurance to cover existing homes, is going to start in the next 10 years. So with about between 6 and 10 centimeters of sea level rise, we will already see some houses losing insurance because of that sea level rise. 6 centimeters, of course, doesn't sound like much, but it changes the tails of the likelihood of a storm hitting those houses. And of course, once we assume that once the risk is at 2% annual exceedance probability, then there is going to start to be partial retreat. And once it's at 5% annual exceedance probability, then there is full retreat. So insurance is no longer willing to insure that house. Partial retreat means maybe a higher deductible or significantly higher premiums or something like that. Okay, there is an interesting detail here, and why the question is why would different cities experience it differently? That has to, the timing of insurance retreat, that has to do with the tidal range. Something we didn't think about at first, but realized that the tidal range is very important. So a city that has a bigger tidal range will experience insurance retreat later, because it's less likely that a storm will top the existing defenses when the insurance the tidal range is high, because basically because the place is less hours of the day. The sea is at close to the protection, the limit of protection. So that's why Wellington, for example, will experience insurance retreat earlier than Auckland, because the tidal range is much narrower. It's about one meter in Wellington and about 2.5 meters in Auckland. Okay, so insurance retreat is a big issue. One can estimate potentially when that insurance retreat will happen. And then, of course, I think there's a lot of interesting political discussion and political research that needs to be done about when exactly, what happens when there is private insurance retreat. Typically, what we observe in many countries is the public sector steps in and provides insurance coverage, oftentimes in programs that are ill-designed from an economic standpoint. So the classic ill-designed program is the National Flood Insurance Program in the US, but I could equally argue that flood re in the UK is similarly ill-conceived. The last thing about risk sharing is when you share the risk, you also want to think about where that risk ends up. The picture on the right there is from London. The reason I put it there is not because it's the ugliest building in London, although it is, but because that's the Lloyd's building. So the reinsurer, the biggest reinsurer, Lloyd's is in that. That's the Lloyd's building. So eventually risk ends up somewhere. Somebody already, we had a discussion already that suggested that it's actually always ends up with taxpayers. I'm not exactly sure that that's the case, but oftentimes it is. Oftentimes it is. It ends up being with the either the reinsurer, if there is reinsurance, sufficient reinsurance, and if there is no sufficient reinsurance, it sometimes ends up with the taxpayer. So that's an important thing to always keep in mind. About avoiding destitution, the second sort of aim of insurance, whether there is the parable of the Good Samaritan. So you're probably familiar with that more than I am. I'm Jewish, but this is a story in the New Testament where the Samaritan is seeing this person who is hurt and decides whether they this is potentially an enemy, and they need to decide whether they help them or not. So we talk about that as the Samaritan's dilemma. Should we always provide assistance irrespective of insurance? And that's an interesting dilemma. We do have evidence for that. So this is what we call charity hazard. In contrast to moral hazard, so moral hazard changes is a change in the incentives pre-event. So if you provide insurance, you're creating moral hazard. But post-event, you have the charity hazard, meaning you assist those people who are damaged or hurt by the event, and therefore you reduce their incentive to in the future protect against future events and or buy insurance. So purchase insurance or somehow arrange for insurance. The evidence on these two is actually there is quite a lot of evidence on charity hazard as a relevant consideration. On moral hazard, there's a lot less evidence. I think that this is actually a viable concern that insurance creates moral hazard, and therefore we should limit the amount of insurance that we provide, or maybe only provide insurance when there are also in the contracts incentives for risk reduction. There's remarkably little evidence that this is actually a significant real concern. And I've tried to look in a few places, and I wasn't able to find much evidence for moral hazard. Now, the third issue that we talked about is speeding and improving recovery. So what is the evidence for that? First of all, speeding recovery. So we had a big event in New Zealand, and I already mentioned that, the Christchurch earthquake. What's the evidence we have on that? Well, what we know is that you can divide those people who experience damages, and here I'm talking about businesses, so businesses who experience damages, into those that had no insurance. About 25% of businesses had no insurance. 75% had insurance. Some of them had insurance, were paid promptly, and got on with their businesses. Some people, some businesses had insurance, but it took them a while to get paid. Okay, and that's not atypical. So a lot of times after big events, we see that resolving insurance claims takes a while. Okay, so what we did is using survey data, we looked at the recovery of these businesses. Now we know that the businesses that had no insurance recovered significantly worse than businesses that, in terms of any kind of metric that you want to use, income or profits or whatever, businesses that had no insurance recovered way worse than businesses that had insurance and were paid promptly. The interesting finding is that that group in the middle that had insurance, but it took them a while to get paid, they actually didn't recover any better than those businesses that had no insurance. We actually have some evidence to suggest that they recovered worse than the businesses that had no insurance. So why did having insurance and getting paid later make you recover worse than if you had no insurance at all? Basically because it delayed you taking decisions how to revitalize your business. Because if you had no insurance contract, you just got on with it. If you had no insurance contract, you just got on with it. If you did have insurance contract, then you started negotiating with your insurer, and you basically that immobilized you from making necessary decisions on how to recover. So in this case, at least, we have some evidence to suggest that it's not always the case that the insurance speeds up recovery. It only speeds up recovery if the insurance claims are paid on time. And that's a big if, because we have a lot of evidence that that's not always the case. Okay. What about households? We did similar research on households in Christchurch. So we looked at households and their recovery. In this case, we had no households with no insurance. Almost everyone is insured for earthquakes in New Zealand. That's unusual. So the insurance coverage rate for households, for homes, was about 98%. That's vastly different in most other countries. In Italy, for example, it's about, I think, 2 or 3% of houses are insured for earthquakes. In Japan, it's about 30%. In California, it's about 12%. So the experience in New Zealand is quite unique, but everybody has insurance. But we found that, again, we had some houses that were paid promptly and some houses that were paid with some delay, and we found that the areas that were paid promptly recovered much better than those that were paid later. Not a very surprising maybe finding, but suggests that there is a room for policy to make sure that payments for insurance claims is done promptly. And typically we don't observe the regulators intervening in the speed in which insurers settle claims, and that might be a mistake. Okay, the second question then is, does insurance, we know it doesn't necessarily speed recovery, but does it improve recovery? And here we have an interesting, again, from the same example from Christchurch. If you think of a building that got damaged by an earthquake, there's 2 steps in that decision. First of all, what to do with the building. You can demolish the building or you can fix it. Now, typically fixing a building is much faster and improves recovery because there's a lot of positive externality from a building.
You have 5 minutes left. Thanks.
Excellent, perfect. I'm going to finish in 5 minutes. So fixing a building quickly has clear positive externalities because it provides revenue and income to other businesses who depend on that building. So think of an office building. Now, so an office building is damaged, you can either demolish it or fix it. We know that there are a lot of positive externalities with the building going back into operations as quickly as possible. But what we observed in New Zealand is that insurance typically incentivized the demolition of the building. Because the way insurance contracts were written, it was much more profitable for building owners, office building owners, to demolish their buildings than to fix it. So we ended up, because there was so much insurance, we ended up with a lot more demolitions than was optimal, and a lot more demolitions of buildings that could have been potentially fixed. And we ended up, because of that, with a delayed recovery. And actually 10 years after the earthquake, the center of the city of Christchurch is still far from being completely reconstructed. So clearly here in this case, the insurance incentivized the wrong choice. So it didn't improve recovery. It actually maybe even made it worse. The other interesting sort of question there is, a lot of times the insurer is asking whether they, once they have decided there is a valid claim, whether they should pay cash to the owner of the claim, or whether the insurance itself, the insurance company itself, should fix whatever was damaged. And here we have sort of interesting evidence from again from Christchurch. If the insurance company chose to pay cash rather than fix the building, then the economic recovery of the area was better, because there was more liquid cash available in the area for businesses, and that generated positive externalities and multiplier effect, and think of it as a local stimulus. Okay, so if the insurance company is paying cash, there's better economic recovery to the region that is receiving those cash. On the other hand, when you look at property prices, paying cash reduces the property prices in the region, because what you have is then some homeowners who have been paid cash for their home do not fix it. They use the cash, and that's why you have this additional stimulus in the economy and better economic recovery, because homeowners do not use the cash to fix their building. So what you end up with is, you observe in the data reduction in home prices in areas where there was more cash payments versus fixing the building. So you have this trade-off between better economic recovery but longer-term decline in house prices, which of course has its own externalities associated with it. So the picture, what I'm trying to say is, the picture of what insurance does is actually quite nuanced, and it actually quite a lot depends on how insurance contracts are written, what incentives that those terms create, for example, to demolish or to fix, how compensation is done, how fast it is done, in what way it is done. All of these things have an impact on the way insurance performs, and are typically overlooked when we assess the desirability of insurance. Last point I want to make is the pandemic. This is actually taken from a Swiss Re ad that I saw just a few days ago, in which they wanted to point out that the pandemic, COVID-19, was not a black swan. For me, the analogy of the metaphor of a black swan is a bit odd, because every day when I walk to work, I pass a lot of black swans. We actually have black swans in the Southern Hemisphere. But of course, for you in the Northern Hemisphere, black swans are sort of these inconceivable, that's at least the way that the Greeks saw them, inconceivable concept. And because of that, that's why Nissim Taleb called these unexpected events, or events we don't conceive of as possible, as black swans. But Swiss Re points out that actually COVID-19 was not a black swan at all. It was a fairly expected event in terms of the epidemic of it, the epidemiological details here. Most predictions about epidemics done maybe, let's say, 10 years ago, said that the likeliest event is going to be a global pandemic that originates either from a flu-like respiratory, or from a flu, an influenza strain, or from a coronavirus. So we ended up with a coronavirus that acts like a flu in the sense that it's a respiratory, spreads like the flu. Of course, it's more deadly than the flu, but it spreads like the flu. So what Swiss Re points out, and it's not really a black swan, but then why did almost no one have had pandemic insurance? Generally speaking, the insurance sector came out of this event, even though it was the biggest disaster in our lifetimes, and the biggest decline in economic activity since the Great Depression. Insurance companies, it's hardly a ripple for them because almost no one had pandemic insurance. So there's a lot of interesting questions about why there was no pandemic insurance, even though Swiss Re, among others, tried to sell pandemic insurance before the pandemic, but nobody wanted to buy it. So there's a lot of interesting questions about why did people not buy pandemic insurance? Why did people underestimate this risk? What's the likelihood of other risks being similarly underappreciated? What's the consequence of people underestimating risk in terms of their demand for insurance? Can you generate insurance contracts that are more likely to generate insurance purchases by people who underestimate this risk? There's a lot of interesting questions that one can ask with experimental methods, with theoretical. I think there's a lot of theoretically interesting questions there. We're working on a few of them, but there's a lot of other things. And you know, if we talk to, and Alessio mentioned business interruption insurance, almost no one had business interruption insurance for pandemics. Clearly, a lot of people now want business interruption insurance for pandemics. Now, of course, right now, this kind of coverage would be incredibly expensive. But there's a lot of questions there, and I think I'm going to leave it at that.
Thank you very much, Ilan. That was a great talk. Really enjoyed that. So we already have 3 questions in the Q&A chat. So the first question is as follows. Do climate change impacts categorized as natural disasters?
There's a lot of climate change impact. The climate change impacts I'm interested in are the changing in the frequency and intensity of extreme events. Okay, I actually have some work that looks at quantifying the change in the probability of extreme events and tying, therefore, the damage from a disaster to extreme events. I'm working right now on a paper that looks at Hurricane Harvey in the US, which there was a lot of flooding. We know that a lot of that flooding is associated with climate change, with the change in the temperature in the Gulf of Mexico, which that meant that the higher temperature in the Gulf of Mexico meant more rain. Because of that, there was more flooding associated with that hurricane. And what we're trying to do is quantify the increasing or basically quantifying actually the houses that were flooded because of climate change, okay, in Hurricane Harvey. So identify those houses that if the Gulf of Mexico had the temperature it had without that, it would have had without climate change, those houses wouldn't have been flooded. But because of course we do have climate change, those houses were flooded. So we can identify actually specific properties and say this house is flooded because of climate change. And that also has implications for insurance. You know, I can envision, for example, an insurance company that covered that house suing an oil company saying, actually, that risk is because of you. We need to cover that flooding damage to that house because of climate change, and you're responsible for climate change. Therefore, actually, it's your responsibility, not the insurance company. There's a lot of interesting questions around these issues. but climate change has many impacts. One of them is changing in the intensity and frequency of some events. Of course, some events are becoming less frequent or less intense, like cold spells.
Great.
But, yeah.
Yeah, we have a few more questions.
Sure.
Hi, Ilan, from Ryan Bell. Given the importance of receiving prompt payment for an insurance claim, how do insurers decide who receives payment the earliest? Could the current system be made more fair?
I don't think there is a current system, so every insurance company arranges it differently. And a lot of times I think the people who shout the loudest get paid first, or the people who are first in the queue. Is that a reasonable system? I don't think it's a reasonable system. So, you know, can we design better systems in which we prioritize payment with some other metric other than if you shout loudest or if you are first in the queue, or if you have the most expensive lawyer? Yeah, I think we can. Oftentimes that's not the case, and oftentimes the regulators don't seem to get involved in those kind of questions. And that's a mistake, I think. Great,
thanks. So another question from Asbjørn Torvanger, apologies for my pronunciation, from Cicero, Norway. Difficult to insure if everybody is hit by a pandemic. Who to share with?
Yeah, a pandemic is difficult to insure because there's, you know, we can share with the Martians, but they're not interested. Clearly, a pandemic of this scale is not an insurable event. Although, if we think more specifically on some aspects of the pandemic, not everybody is damaged by, not all businesses, for example, are damaged by the pandemic. And some businesses are damaged. Actually, you know, Zoom is doing very well because of the pandemic. And while tourism businesses, of course, are doing much worse. So there is maybe potentially opportunity for some risk sharing there. But clearly, pandemics is a difficult one to insure for. But the fact is that the insurance companies were offering coverage, and actually quite cheaply, before the pandemic, because they underestimated the risk. So, you know, you could have purchased a very affordable pandemic insurance, you know, a year ago. Now it's much more difficult. So yeah.
Good. So another question, is there some research on the effect of uncertainty in risk modeling on insurance, and especially insurance policy? Basically, making a risk model for a 1 in 1,000 years event is more or less impossible to calibrate, validate for most natural catastrophe events.
For private insurers, we know relatively little about how they model the risk, because either the risk is modeled in-house by the insurance companies, if these are the very big insurance companies, or they're using one of the big you know, risk modelers like RMS or Air Worldwide. And these are all proprietary risk models, so we don't really know what they're doing. So we have, you know, there is just clearly uncertainty around what they're doing, but we can't quantify it. There has been, I think, almost now clearly insurance companies are aware that there is some uncertainty, and they are pricing some of that uncertainty into their premiums. Sometimes, of course, they're mispricing it. We know, for example, in New Zealand, we were fortunate that most of the insurance companies, actually all the insurance companies, were underpricing earthquake risk. And we had a big event in Christchurch in 2011. And up to 2011, the risk was underpriced. So this is not a, most New Zealanders don't like to hear that, but actually New Zealand made money in the earthquake because we got it was such a heavily insured event, and we were underpaying for the risk. So New Zealand overall made money out of it. We had massive reinsurance globally. So sort of New Zealand Inc., as we say, profited from the earthquake. So sometimes, yeah, sometimes it is mispriced.
Great. So last two questions. Insurance companies are commercial company in that they consider profit versus cost. So the insurance companies should have good data of disasters to compare profit and cost. My question, shall pandemics disasters happen frequently before the insurance companies offer disaster pandemic insurances? It's more of a, yeah, reaction versus, like reactive versus proactive approach, I guess.
First of all, I would argue that insurance companies don't necessarily always have very good risk models because risk models are expensive. So sometimes they decide that it's too expensive to model the risk very well, and it's cheaper to just spatially not differentiate between different properties and so on. And that's why as the costs of risk modeling goes down, we observe less and less risk sharing across space. So that movement to the left in my little diagram there. So I don't necessarily agree. And we saw that in New Zealand, the risk models that the insurance companies were using were very rudimentary, but that's also because it's a small market. So constructing a good risk model is expensive. There's a lot of fixed costs. You're more likely to have good risk models in bigger markets. But a lot of markets are pretty small. And because the risk is local in many times. So that's local market, therefore the market for that risk, the market for, earthquake risk in the Eastern United States is only around certain areas around the a few fault line, the New Madrid fault line. It's not a very big market, so therefore they don't really have good models of that. So that's the first part of the question. The second part, can you explain maybe what the question was?
Yeah, so shall pandemics disasters happen frequently before the insurance companies offer disaster pandemic insurances? So basically, do companies insure what they saw in the past, or they could also act in a more proactive way?
Insurance companies are reactive in the same way that most of us are, but insurance companies were trying to sell pandemic insurance before COVID-19. So while most of us, including most businesses, were overlooking this risk, and I include myself, and I'm actually ashamed to say that I did 2 papers on pandemic risk last year in 2019. Both of them are available online since 2019, but I didn't appreciate how deep a recession will result from what is a relatively moderately strong virus. So it's not, this virus is not nearly as deadly as SARS, for example. Or much less deadly than Ebola or even the H1N1 influenza that hit in 1918. But the economic decline is deeper than even what we experienced in 1918. We think we don't have good data on that. But I didn't appreciate that. But insurance companies were trying to sell coverage. But generally speaking, we see that insurance companies are also reactive, and that's why after big events, they typically start to refuse to cover that event. And we saw that I just gave the example of the fires in California.
Okay. So what kind of insurance for developing countries where the insurance system is not well developed and natural disaster are very frequent?
So first of all, as we said about pandemics, if it's very if something is very frequent, or it covers the, it hits the whole country, it's very difficult to insure. Now there are solutions. There's a lot of discussions and try to implement parametric insurance. I think in some instances parametric insurance makes sense. I think one example would be business interruption insurance for pandemics, but very often parametric insurance is not a very sensible solution. So we saw, for example, parametric insurance being adopted as for sovereign insurance. This is a program encouraged by the World Bank in the Caribbean, in the Pacific, in the African risk capacity, in Central Asia. Those programs, in my view, don't make any sense. But we see other examples where parametric insurance might be a solution for low and middle income countries. But again, the devil is in the details, exactly what risk is being covered, and exactly how to formulate the index, minimize the basis risk, and so on.
Yeah, indeed. So Krista Clapp writes, how do you think the impacts of rising catastrophe costs will play out? For example, will private insurance and reinsurance companies end up reducing coverage, and what are the implications of inequality in public insurance programs?
Yeah, that's why I'm writing. That's why I'm doing research on all these things, because I think that's exactly what will happen. The private insurers, there is a misperception that private insurance is part of the solution to climate change, but largely it's not, because private insurers are only covering infrequent events, and once events become more frequent, private insurance is no longer available. So that means that then we have to rely on public systems, but the public systems, they need to be very carefully designed, so that they create the right incentives, so that they generate all these 5 points that I suggested. Insurance, we should strive for insurance to provide, including the incentivizing of risk reduction, the speeding up and improving recovery, avoiding destitution, all of these things. And make sure that the risk sharing is not done from the poor to the rich, where actually the rich are offloading the risk on the poor, which is clearly something that from a public, from an ethical perspective, we don't want, or at least I don't. But we need to design those things very carefully, and in some cases, we need to solve do risk reduction rather than insurance. So through managed retreats and things like that. Managed retreats are another topic for which I can talk about endlessly, but that's not for this time, I think.
Wonderful. So last question from Masood Kamisabadi. How can we model economic business interruptions?
That's a difficult one. It's not clear to me that we can. If you look at different events, and you see that the pattern of business interruption is very different, and modeling that is very complicated, I think. That's part of the reason why I think parametric insurance might make more sense for business interruption, because it's a risk that's very difficult to model. It might make more sense to sell it as a parametric product, that if you are hit by a certain event with a certain established threshold, you get paid some pre-agreed amount, and the insurance therefore doesn't really have to try and model what would have been the decline in your business because of this event, because they already agreed on the amount. They don't care what was the actual decline in your business. They only care about what was the agreed amount. So I think with business interruption insurance, that's one region where parametric insurance can significantly lower costs because of the difficulty of modeling. Some business interruption channels are easier to model than others, but if you look at the example of specific cases, you see that there's a lot of unexpected things that happen, and every catastrophe is sort of its own unique story, which means that we can't model it.
Great, thank you very much, Ilan. I guess this is all.